Hi everyone. Welcome back to Canada Accounting Insights. Today we're diving into one of the most important and sometimes tricky standards in accounting, IFRS 15, Revenue from Contracts with Customers. This is the backbone of how companies recognize revenue, and if you're studying for your CPA exams or working in practice, this standard is absolutely everywhere. Before we get started, don't forget to hit the like button and subscribe to the channel. It really helps us keep bringing you these practical, real-world tutorials. So let's start at the very beginning. What do we actually mean by revenue under IFRS 15? Revenue is defined as income arising in the course of an entity's ordinary activities from contracts with customers. That last part is key. Ordinary activities. If your company sells software, your revenue comes from software contracts, not from selling your office furniture. Those would be gains, not revenue. But here's the issue. Contracts today aren't always simple. Think about software subscriptions, bundled products, loyalty programs, or construction projects. Recognizing revenue at the wrong time can mislead stakeholders and even cause compliance issues. That's why IFRS 15 exists, to bring consistency through a five-step model, which are: Step 1. Identify the contract with a customer. Step 2. Identify the performance obligations. Step 3. Determine the transaction price. Step 4. Allocate the transaction price. Step 5. Recognize revenue when or as performance obligations are satisfied. All right, let's break it down step by step. For an agreement to count as a contract under IFRS 15, 5 conditions must be met. Both parties approve it. Each party's rights and obligations are clear. Payment terms are spelled out. The deal has commercial substance, meaning it changes cash flows. It's probable you'll actually collect the money. If even one of these is missing, you don't have a valid contract under IFRS 15. Now, what if a company signs multiple agreements with the same customer? IFRS 15 says sometimes those must be combined if they're negotiated together or linked in substance. And contracts don't always stay the same. They get changed, updated, or extended. That's where contract modifications come in. Sometimes a modification is treated as a separate new contract, other times it adjusts the existing one. Example: a builder signs a $100,000 garage contract, then the customer adds a $20,000 shed. If that shed is priced separately and could stand alone, treat it as a new contract. If not, adjust the old one. Once you know you have a valid contract, the next step is to figure out what promises are inside that contract. Performance obligations are just a fancy way of saying, what did the company promise to deliver? A good or service is distinct if the customer can benefit from it on its own and it's separately identifiable in the contract. For example, a phone company sells a handset plus monthly service. Two distinct promises. But if you're selling customized machinery plus installation, and the two can't really be separated, that's one combined performance obligation. Once you've listed all the promises, the next question is, how much are those promises worth? That leads us into the transaction price. The transaction price is the amount you expect to be entitled to. But contracts are rarely simple, right? Let's break down the main considerations. Variable consideration. Things like discounts, rebates, bonuses, or penalties. Use the expected value method, a probability-weighted average, or the most likely amount method, if only two outcomes. And don't forget the constraint. Only include amounts if it's highly probable you won't have to reverse them later. Significant financing component. If the timing of payment gives financing benefits, like paying years in advance, you may need to separate interest from revenue. Non-cash consideration. If the customer pays with goods or shares instead of cash, measure it at fair value. Consideration payable to a customer. Rebates, coupons, or payments you owe back to the customer reduce the transaction price. So now you've got the transaction price. But if the contract has multiple promises, how do you split it? That's where allocation comes in. When there are multiple performance obligations, you need to allocate the total transaction price to each one based on its standalone selling price. And if you don't know the standalone price, IFRS 15 gives us three methods: adjusted market assessment. What would customers pay in the market? Expected cost plus margin. Estimate the cost and add a profit margin. Residual approach. Use this only when other prices are observable and one isn't. Example: a phone and service bundle sold for $1,500. If the phone normally sells for $600 and the plan for $1,200, you allocate proportionally, not just evenly. Once the price is allocated, the final step is deciding when to recognize revenue. Revenue is recognized when, or as, performance obligations are satisfied. Overtime applies when the customer simultaneously receives and consumes benefits. The customer controls the asset as it's created. Or, the asset has no alternative use and you have a right to payment. Point in time applies when control transfers at delivery. Example: delivering the handset equals point in time. Providing monthly phone service equals overtime. Now, quick note for my Canadian viewers. Under ASPE, revenue recognition is simpler. Revenue is recognized when performance is achieved, the amount can be reliably measured, and collection is reasonably assured. Much less detailed than IFRS 15, but also less precise when it comes to complex contracts. And with that, let's wrap everything up. So, IFRS 15 in a nutshell. Revenue equals income from ordinary activities under contracts with customers. 5 steps. Identify the contract. Identify performance obligations. Determine transaction price. Allocate the price. And recognize revenue. Plus, we need to consider contract modifications, variable consideration, financing, and allocation methods. It might feel like a lot, but once you practice with examples, it becomes much more intuitive. If this breakdown helped you, please like this video, subscribe to the channel, and share it with your classmates or colleagues. And I'd love to hear from you. Which part of IFRS 15 do you find the most challenging? Contract modifications, allocation, or variable consideration? Drop it in the comments below, and I'll make sure to cover it in a future video. Thanks for watching, and I'll see you in the next one.